Hey, welcome in to Make Your Money Matter. I'm your host, Brad Barrett, and our goal with each show each week is to aim to help you create a better relationship with your money. And this week we're going to go touch on volatility versus variability. Now, I touched on volatility that we see in markets on a previous episode, and I went into really two definitions of volatility. One was standard deviation, which is the statistical measure that quantifies the amount of variation or dispersion of a set of data points, right? And the other one was implied volatility, which is a measure of market participants' expectations. But I want to go one step further because we got a lot of comments and a lot of suggestions on this that I really liked, because I think as it relates to volatility being a measure of risk, and I want to define that today because I think there's a lot more to dissect on that. But before we get started, make sure to smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. So we as human beings, we try our best to avoid people and places and situations that are what? They're volatile, right? And the reason, of course, for this is they generally involve something called risk, okay? So when it comes to investing, like in my world as an advisor, especially in the capital markets or the stock market, most of us will equate volatility with risk. But I want to share something that we talk about here at One Capital Management that we believe that is somewhat misleading. Now, that statement alone that I just made is actually risky on our part, if you think about it, and I want to explain that from our view. Generally, when the word volatility is used in reference to investing, it's used to describe a large decline or maybe a period of rapid ups and downs in the prices or returns of holdings or stocks or your portfolio. And we can all agree on that. So let's first look at this, at how volatility is defined from really well-trafficked investing website, like something like Investopedia, which is a great reference point. And it says this: volatility is a statistical measure of the dispersion of returns for a given security or market index. Now, in most cases, the higher the volatility, the riskier the security. And we talked about this on our previous show as well. If you want to go back into more of the statistical analysis of how we look at volatility, you can refer to that show. Now, indeed, volatility is the statistical measure of the dispersion of returns for, again, a given investment or portfolio. However, in an investment like overall portfolio with a higher dispersion of returns, it doesn't necessarily mean it's risky. It just means that the returns had a higher degree of variability around the average of the individual returns in a given period. Okay, so let's go back for a second. I want to simply define or maybe redefine volatility as variability. So as such, variability is not risk. So unless you're forced to sell into the downside of variance, then it becomes risk, but that's a separate matter, right? There's a whole other side to that. But let's go through this. It's risky to take on too much variability when your time horizon is short and you don't have enough really, stable assets to access liquidity, if you will, if necessary. We talk about this with planning with my clients. We always talk about liquid reserves, emergency funds. We talk about, your middle, your short-term, and your long-term buckets for your overall time period. These matter. Now, outside of that, with adequate time and assets, you can actually hold a great investment through periods of variability, especially the downside variability, because obviously this year, if you look at 2023, we've seen a big uptick in the markets, but we're also coming off a bear market from last year in the markets in general, which were off almost 22%. Now, our portfolios at One Capital were not because here we had diversification. We managed the variability and volatility well, like many of your managers should be doing for you through a diversified and active portfolio. But variability can provide an opportunity for disciplined investors. I mentioned this before, that volatility in general can be a good friend to you if you know what you're looking for. So we should, in the words of Warren Buffett as an example, view it as our friend rather than our enemy. Profit from folly rather than participate in it, as he says. Remember here, everyone that is investing in the market is buying and selling ownership of a business that, like in its purest form, okay, that's what you're doing. If careful analysis tells us that the intrinsic value of a business, the current price, merely tells us if it's overvalued or undervalued. That's our job as portfolio managers for our clients, is to help determine that. But we focus on the intrinsic value. Let me give you a little story on this, a little allegory. And this was actually created by a famed analyst, a guy named Benjamin Graham. He helps demonstrate this, and I think it's important for you to see this. Imagine you co-own a healthy, stable, growing private business with Mr. Jones. And now Mr. Jones is an emotional guy who swings from wildly optimistic to like darkly pessimistic. Now every day, Mr. Jones comes to you and either offers to buy your interest in the company or to sell his share to you. He's up and down all the time. He's like a June bug, okay? Just bouncing around. Now, When he's feeling sunny, for example, he offers you a very high value or price to buy your share out because you co-own this business with him. But when he's, all of a sudden he thinks the sky is falling and doom and gloom is happening, he offers what? A very low price to you. And he's persistent on this. Now, if you're uninterested in an offer, he'll back down the next day with a new one, right? This is how a person like this works, right? You know that gloomier Mr. Jones is the better chance that one day he will offer to sell you his share at a price that works for you. So, you have to think about it. It has to be considered foolish folly, as Mr. Buffett says, to consider this. And this is the time when you profit, okay? You see, variability can help correct imbalances. That's actually what we're trying to do as market makers, as managers of portfolios. Now, in many ways, the investment world, I've always been in it so long, it's somewhat Darwinism, right? Survival of the fittest, as we learned. And higher variability often does what? It thins the herd, okay? In periods of higher variability, corporate shortcomings, they'll get exposed, right? And investors, the marketplace in general, who bought without studying the company fundamentals or the sector fundamentals or their industries, right? They'll often sell in the droves when you see things coming around. A pastor used to tell me that we are always in control. We are the air traffic controller of the thoughts that enter our minds. And this includes thoughts of, our emotions and our irrational thoughts even. Remember our friend Mr. Jones here, who we co-own this business with? I want to ask you this question. Are you the emotional investor that is riding the lightning every day and every day is, some new emotion? And if we really, dig down into it, because a lot of what I do with our clients here at One Capital is really digging down into almost the psychotherapy as their emotions around the markets, because it typically comes from something that they heard, something that they learned about. And that's all good, but we need to be able to talk it out and go and derive the actual intrinsic value of a company or a sector that they're talking about, because you might be fearful of the sector or that part of the economy that you're fearful of. And this is how we end up, we don't become part of the herd, right? We want to make sure we separate ourselves, okay? It matters how we react, as I share all the time. What we do versus what we don't do in markets matter. And we at One Capital Management, I can only speak to us, we're always looking for those opportunities created during high variable markets. And we're also buying companies and asset classes of different characteristics. In essence, as we know the world, I'm going to say we're diversifying across various economic sectors, various geographic regions, as well as big and small companies in fixed income versus maybe equity markets. And we also will set risk parameters. I think that's really important because we're talking about variability today, right? We're talking, going in through this, we're talking about just the general risk, the notion of risk. Setting risk parameters does actually matter. And I want you to know that it's not that we walk into every day in this world with inherent risk. We know this, right? Now, when we talk about market risk or someone wants to quantify risk, I almost have to stop them and make sure that we understand that in economics, we learn that there's multiple different types of risk. People just deem it risk, right? There's interest rate risk, there's buying opportunity risk, there's opportunity cost risk, there's credit risk, inflation risk. Interest rate risk, market risk, capital loss risk. I can go on and on here. So we're just talking about generalizing one risk of market risk. But the reality is, by removing just one of them, we inherently still have others. So setting risk parameters is a really important factor here when it comes to your actual portfolio design and your portfolio construction. And also knowing that if we can reduce volatility and variability, we may be better able to control the emotional response that you might have to variability, which we all have, by the way. Anyone human, we have this, right? Especially when the variability when it comes to the downside, right? Because you have variability on the upside, but the downside is what really gets us. Now, of course, there's always going to be bumps along the way when it comes to long-term investing. If it just went all the way straight up in a linear line, no one would have an issue with markets, right? But because the market, let's just break it down for a second. We are the market, okay? Human beings, all of us, you and I, we are the market. But we prefer here at One Capital to focus on the steady upward slope of what we call wealth building over time, rather than, I think, the jagged lines that you might look at day to day, of a volatility graph. So as you read or hear about market volatility in the future, as you undoubtedly will, right? Just remember this, refer back to this video, right? Don't think of it as volatility or risk, think of it as variability. You can talk with your friends about this and actually look kind of smart here, right? Don't think about volatility or risk, think about it, it's variability. And then remember, recall the old story about the young man who found himself next to the late JP Morgan, all right, hoping to capitalize on the moment. He asked the famed financier his opinion on the future course of the stock market. And this is how Morgan replied. This is how I'll end it today. I believe, son, the market is going to fluctuate. Big aha moment, but But I think it's important for you to remember that. Hey, I want to thank you for watching our show today. Don't forget to subscribe to our channel so you don't miss an episode. And always remember to make your money matter.